Imagine an economy where thousands of companies should be gone, yet their lights stay on. Staff still clock in daily, and banks keep rolling loans like nothing is wrong. In today's video, we explore how cheap credit in Japan sustains so-called zombie firms. We explain why this matters for your money, investments, and the global economy. Picture walking through a busy Tokyo street glowing with neon and crowded restaurants. Everything appears normal from the outside, alive with movement and constant activity. Yet many businesses there are not financially alive in any meaningful sense. They earn enough to pay interest, but never enough to reduce debt. They cannot invest, expand, or grow beyond mere survival. These companies exist in limbo, neither dead nor healthy, year after year. In finance, these firms are known as zombie companies. Japan is widely considered the original birthplace of the zombie company concept. After Japan's asset bubble burst in the early 1990s, growth collapsed. The country entered what became known as the lost decade. Economic growth weakened, prices fell, and confidence slowly evaporated. Many firms should have gone bankrupt during this period. Instead, banks and government institutions chose to keep them alive. They used support programs, easy credit, and extremely low interest rates. A zombie company survives only because someone lends to it very cheaply. One definition requires firms be over 10 years old and financially distressed. Their interest coverage ratio stays below 1 for at least 3 years. That means earnings cannot fully cover interest payments on existing debt. Each year, these firms need new loans just to remain open. Think of someone using new credit cards to pay old balances. The debt never shrinks and nothing productive gets built. One small shock can collapse the entire fragile structure. This is how zombie companies shuffle forward, barely functioning. In Japan, zombies are not a tiny fringe group. A Tikoku Databank survey estimated 17% of firms were zombies. That equals roughly 250,000 companies in fiscal 2022. Nearly 1 in 5 businesses existed between survival and collapse. Some sectors show even higher zombie concentrations. Retail businesses showed zombie rates approaching 28%. Transportation and communication sectors exceeded 20% zombie shares. Manufacturing was close behind with similarly troubling figures. Smaller firms faced the highest zombie risk overall. Businesses with 5 or fewer employees had zombie rates above 25%. To understand why, we must revisit Japan's late 1980s bubble. Land and stock prices reached extreme and unsustainable levels. When the bubble burst, asset prices collapsed rapidly. Banks were left holding massive amounts of bad loans. Many borrowers were technically insolvent overnight. Japan then faced a painful economic choice. It could force bankruptcies or quietly delay losses. Leaders chose stability over short-term destruction. Banks rolled over loans instead of recognizing losses. Economists later labeled this approach zombie lending. Weak firms received new credit instead of being written off. This strategy reduced immediate unemployment and social unrest. However, postponing pain created deeper long-term costs. Capital, labor, and land remained trapped in unproductive firms. Stronger companies struggled to access resources needed for expansion. Zombies effectively crowded out healthier competitors. Studies found job destruction remained low in zombie-heavy sectors. However, job creation also stayed weak and stagnant. New firms found it difficult to enter or grow. The result was economic stagnation rather than collapse. Later, the Bank of Japan pushed interest rates near zero. These ultra-low rates lasted for decades. They aimed to fight deflation and support borrowers. They also created ideal conditions for zombie survival. Low rates made rolling over weak loans extremely cheap. Banks could justify lending to firms with minimal profits. Over time, extending credit became habitual. Banks avoided admitting losses by endlessly refinancing borrowers. Public credit guarantees reinforced this behavior. Government programs protected banks from some lending losses. This reduced incentives to strictly screen borrowers. During crises, Japan expanded these support schemes further. The global financial crisis brought additional loan rescheduling programs. The pandemic triggered massive government-backed lending to small businesses. Many firms survived but accumulated heavy unpayable debts. Demand recovered slowly, leaving firms financially hollow. Zombie firm numbers jumped roughly 30% after the pandemic. Fiscal 2022 marked the highest level in 11 years. The intention was protecting jobs and communities. The unintended result was a larger zombie population. Japan continues this approach due to difficult trade-offs. Rapid failures cause political, social, and economic backlash. Allowing zombies softens recessions but slows long-term growth. Productivity growth suffers as inefficient firms persist. Healthy firms reduce investment due to distorted competition. Zombie-heavy sectors show weaker profits and innovation. Zombies also affect price dynamics across the economy. They cut prices aggressively just to survive. Low margins contribute to deflationary pressure. This behavior likely reinforced Japan's low inflation struggle. Consider a small regional Japanese family-owned hotel. It expanded before the crash using borrowed money. After downturns, profits collapsed and debt became unmanageable. Strict markets would force closure and asset seizure. Instead, banks rolled over loans at low interest. Local governments provided partial guarantees. The hotel survived but never recovered. Maintenance was delayed and staff reduced. New entrepreneurs struggled to compete or enter. Prime land remained occupied by inefficient businesses. Multiply this across the economy and stagnation spreads. Change slows and risk-taking becomes unattractive. This is not only a Japanese phenomenon. Similar zombie patterns emerged in Europe after financial crises. Cheap credit and weak banks produced similar outcomes. Japan's lesson is a global warning. Low interest rates are not a free lunch. They change incentives for banks and borrowers. Weak firms survive longer than expected. Bad investments remain unresolved. Banking health becomes critically important. Hidden losses encourage extend and pretend strategies. Public credit guarantees require careful limits. Used too long, they embed zombie risks. As rates rise, zombie weaknesses become visible. Even small rate increases strain fragile firms. Banks must then decide whether to support or cut loose. Mass failures risk financial instability and layoffs. Handled carefully, restructuring can boost productivity. Japan is cautiously navigating this transition. Some advocate gradual withdrawal of support. Others warn delays increase future costs. The outcome will likely be messy and uneven. Japan's zombie firms matter globally for investors. Japanese institutions hold large overseas asset portfolios. Domestic stress can influence global markets and currencies. Investors should examine earnings quality carefully. Firms barely covering interest deserve skepticism. Rising rates expose fragile balance sheets quickly. Founders should avoid becoming hidden zombies themselves. Debt-fueled survival without reinvestment signals danger. Cheap credit can delay necessary decisions. Zombies also create opportunities for stronger entrants. Lean firms gain market share when credit tightens. Japan's zombie story reflects risks of prolonged easy money. It shows how stability can suppress renewal. As global rates normalize, zombies will surface everywhere. Japan lived with zombies for decades. The rest of the world may soon meet its own.